How many of us would like to give our dollars more than what Joe? When life insurance is set up and used properly, you can access your money through a collateralized loan, allowing your money to grow. You have people like Walt Disney, who famously used his life insurance policy to help with Disney World. Why in the world do banks have billions of dollars in their tier one assets in what's called bank-owned life insurance? There is so much research going on right now on how life insurance, believe it or not, can enhance and give you more options for retirement income.
Caleb was a person that understood what my superpower was, and he told me before I got to 500,000 subscribers, 700,000 subscribers, he's like, Karlton, you are going to be the voice in tax and accounting. He's like, I've seen Robert Kiyosaki, I've met that guy, I met Tom Wheelwright, you will become that voice. And I've stuck by Caleb, and he helped me with some of my life insurance policies and with some of my clients' life insurance policies, and I realized this guy's superpower is in the and asset, as he would call it, life insurance. And what I want to do is I want to bring up Caleb here today to be able to explain to you guys the power of life insurance, not only as a wealth building tool, but from a tax perspective. Without further ado, Mr. Caleb Gillies.
Now what I want to do before I go into the exciting topic of life insurance is I have a thesis, and my thesis comes down to 2 words. And if you get nothing else from what I'm about to share, I believe these 2 words could be a total game changer and give you a framework of how to think about your life and about your wealth. So the thesis comes down to wealth efficiency. But we have to first answer the question, what is wealth? And I'm curious, how would some of you say, well, what is wealth? How do you define wealth? It's very important. If our goal is to be wealthy, what is wealth?
Freedom.
Freedom, lots of people are saying freedom, love that.
Financial independence?
Financial independence, and so here's a picture of what some people would call one of the world's wealthiest men. He's over 92 years old, he's worth over $100 billion, and who in this room would trade places with Warren Buffett today? Do you realize how crazy that is? Do you realize how crazy this is, that none of us in this room would trade places with one of the world's wealthiest men? That means on a macro level we value more than just money. But on a micro level we devalue it every single day. And so here's ultimate perspective is when we're looking at, well, a lot of you said freedom, I love that. For me and for what we're trying to teach, we have a vision that we want to make intentional living the new wealth metric. Because I get so sick and tired of people talking about net worth and cash flow, and all those things are important. But at the end of the day, they almost elevate that more important than your life. And for us, you're not wealthy if you're not living intentionally. And the beautiful thing is, Karlton's intentional life is different than mine. And your intentional life is different than mine. And who am I to tell you what you should be doing with your time and money? But if we can get really crystal clear on what does intentional living look like, I'm telling you, everything in our life, it becomes the North Star. So that's number 1. That is what quote unquote wealth is. The next question is efficiency. So again, intentional living is the key. Efficiency, what's the definition of efficiency? The ability to avoid wasting materials, energy, efforts, money, and time in producing a desired result. In other words, get really clear about where you want to go and remove any friction to get to that. Every single one of us should want to be efficient. But we need 2 things. You need your desired result, which is ultimately intentional living. How many of us actually know what we truly want? It's a common theme. I can't tell you how many people come to me and they just were like, hey, I want help doing this, and it's like at the end of the day we gotta reverse engineer, like, what do you actually want? What's your desired result? And then the second thing is just eliminate friction. Whether you call it financial planning, whether you call it sales, like if you want to be really good at sales, just help people get really clear on what they want and remove any friction to get you there. I'm telling you that in itself is a total game changer. And so the example of this is like, if you're clear about where you want to go, I live in Nashville and I want to be here in California. I'm really clear about, I want to get to California, and I could walk there, and it would take me 55 days of walking 12 hours. That's not fun. Fun to walk there. I could drive, which some of us have made this drive before, and potentially it's not fun, but you can do it. Or how many people that aren't from California flew here? And it's because it's super efficient. It's not just cheaper, but from a time perspective, and so many people are walking to their destination. And so for me, I just want to take a step back. The reason why I start this whole talk with wealth efficiency is I'm going to be talking about a product And at the end of the day, I don't want us to get over obsessed with like this one product is going to change your life. No product will change your life. I think there's some of the things that I'm going to share with when it comes to life insurance that could be a really. How many of you own life insurance or have heard something? Okay, my goal is very simple, is to make it very simple, and hopefully you might learn something that can enhance what you already have. I'm not talking about investing. I'm not talking about creating. I'm going to be talking about potential strategies that you can control your money better. Okay, and so if you think about this is a dollar bill. This is a dollar bill, and how many of us would like to give our dollars more than one job? Okay, this is just really interesting. If we can have our dollars grow the rest of our life and control it, that's pretty cool. Like that for me was an epiphany. It's like, oh, I can give my dollar more than one job. Pretty cool. And then at the end of the day, if it can potentially help create future cash flow in the future, that's what retirement planning should be called, future cash flow planning. That's pretty cool. And at the end of the day, if it can also protect me, if it also can play a role in the legacy, and that $1 does all those jobs, that's pretty valuable. It's not just one or the other. I'm a one-trick pony, you know? And asset, it's an and it versus or. And so I think regardless, we should say, how can we be more efficient? How can we get one input to do multiple things for us? And so a lot of these names come up. You know, how many of you have heard of like people talking about internet banking on TikTok or Bank on Yourself or dynamic banking or rich person's wealth? I think it should be called now. It's 2024. Cash flow banking. You know, some people call it the volatility buffer. My friend Garrett Henderson wrote the Rockefellers did. Like, there's a lot of different words for this. I wrote the book The And Asset just because that was like my spin on this whole thing. But at the end of the day, this boring asset is specially designed overfunded life insurance. And like, that's what it is. Thank you. No, so it's like, yeah, so usually when we're talking about life insurance, there's a lot of different opinions. I've heard almost all of them. You know, when you create content on YouTube, you get to read about how horrible you are every day. You're like, oh wow, like, and so usually there's a couple, you know, faces that I get. First of all, like, some of you are like, okay, why did I sit in the front row? That's what you're thinking. You're like, why in the world did I sit in the front row? And you're like, okay, this is kind of weird. And then some people are just like, you know, yeah, I could make so many jokes here. But like, there's some people that just think you're like, this is a scam. This is a scam. And I think we have to take a step back and say, not everything is created equal. And so I want to be very clear that not all life insurance is created equal. And so this is not what your friend or relative is selling you. This is not maybe what your parents have. This is not what you've seen on TV. My ask is we take a step back, and my hope is to potentially educate you on one or two things that you may or may not know about life insurance to maybe help you create more efficiency with your dollar. Or make the argument that if you don't have life insurance, you should learn more about it. Okay, so that's my goal in this talk. And so who knows about this? Obviously I trigger everybody with this slide because there's probably somebody on here that's going right. But like, there's politicians that use this. There's banks. Why in the world do banks have billions of dollars in their tier 1 assets in what's called bank-owned life insurance? I don't know. Why is corporations, all these famous corporations use life insurance to retain key employees? You have people like Walt Disney, who famously used his life insurance policy to help with Disney World, and Ray Kroc, who used life insurance to help with payroll when they got the McDonald's off the ground. My friend Garrett Henderson, who literally wrote What the Rockefellers Did. And there's, you know, retirement experts that are talking about it, and there's this really genius who literally teaches people about retirement income. He's writing about it, and you know, there's a PhD in retirement income, which sounds really lame, and he's talking about it. And even, you know, Tom Wheelwright wrote his latest book, and he has chapter 7 in his book talks all about this asset. And we all know this guy. I don't got 500,000 subs, but I have a YouTube channel, and I use Karlton. I tag them and all to get those extra views. And at the end of the day, the whole thesis is give your dollars more than one job. Be efficient. Efficiency, efficiency, efficiency. And so how many, I actually did this talk a week ago in a lot of investors, and I said, how many of you have a cell phone? A smartphone? And there was one person, I asked it a different way. I was like, who doesn't have a smartphone? And of course, there's always that one person. I'm betting there's nobody in this room that does not actually have a smartphone, but I could be wrong. Anyone not have a smartphone? Okay, let me ask you a question. This is going to be a perfect example. Is this phone an investment?
Yeah.
Okay. What kind of rate of return does our phones give us? Is there any nerds in here that are actually doing a rate of return calculation on your phone? Okay. The answer is no. So yes, why do we all have a phone? I believe when we remember efficiency, removing friction to get to where we want to go, how many jobs does our phone give us? It was my alarm clock this morning. It was my white noise machine. It got me a car ride here. I got to text. I got to call. I can make videos. Our phone does so many things. Yeah, it could be a couple $1,000, but like one of the most valuable things that I have. And yes, there's a lot of problems with our cell phones, but you get what I'm saying. What kind of rate of return is it? I don't know. But do you realize that I'm not comparing this to my real estate portfolio or investment portfolio? I would consider this as an and, because this is something that I'm going to have and I'm going to do other things. And my same analogy, I think a lot of times when people talk about any one product or this product, it's like, invest in this. It's not investment advice. This is not even an investment. I think when life insurance is set up and used properly, it's not an investment. I would argue to say it acts more as an and than an or, and I would say that we should think about it more like a cell phone and giving our dollars more than one job. So that's the analogy I would use, and I think all of us have a smartphone for a reason, and so that might land. And so when it comes to life insurance, the epiphany really when I was at the bank, hoping for people to come and see me, I was thinking about these two interesting concepts. Concept number one is compounding, and we talked about it. You all know the power of compound interest. It's like over time, you do an activity and you compound your money over 20, 30, 40 years. It's amazing things. But compounding versus control, I was like 19, 20, 21 years old, and I was thinking, I want to start businesses, I want to do real estate, I want to do other things. And doesn't it feel sometimes that it's like a tug of rope where you can either do one or the other? And for me, when I realized like, oh, because I didn't come out of the womb like wanting to talk about life insurance, okay? But I was like, oh, the epiphany that I had is like, oh, what if you could do both? And maybe that's why, like, even the bank that I was at, the local community bank that I was at, had bank-owned life insurance. I didn't think of it as an investment, but they did it as an efficiency tool. And there's reasons why these banks have it. And so I'm just going to give Life Insurance 101. You'll probably know more than most people that have a life insurance license by the end of my 101. And that's my goal. And then I'm going to go deep into 4 areas. And I really think at the end you'll have a lot of good knowledge of do you want to learn more about this asset class or not. So what is life insurance? Life insurance is a contract. It's a unilateral contract between you and an insurance company. Unilateral is a fancy word for pretty much saying if you keep up your end of the bargain, they're on the hook for theirs. And so not all contracts are created equal, not all insurance companies are created equal. So when you're looking at an insurance company, there's a difference between a mutual company and a stock. Think of mutual as like a credit union. You get extra benefits by being there versus a stock company. They're ultimately serving 2 types. They're serving you, but then ultimately the profits go to the shareholders. Mutual, you are a part shareholder in a company. You obviously you want to work with someone that has good ratings. You want to work with someone that has a long track record. If I start an insurance company tomorrow, it's like, okay, your promise might be a little bit different than a company that's been around for over 100 years. Okay, so every company is a little bit different. You have to understand that not all companies are created equal. But when it comes to life insurance, the majority of life insurance companies on the market are pretty solid, especially if you go mutual. Majority of the mutual insurance companies are pretty solid, especially if they've been around for a while. What's interesting is they all have contracts, and this is where it really gets fun. We want to do what's called overfunding. We want to specially design this where in this example, we can get more cash for this money that we're putting in. And so when you do this, you want to maximize the living benefits. What are living benefits? I'm going to talk about that in a second. You want to maximize all the things that are going to benefit you while you're alive. And in order to maximize that, there's no free lunch in this game. What we have to do is we almost have to drop or minimize the death benefit. Okay, so when we talk about specially designed, we want to engineer a contract where we can max get the benefits. And I'm literally going to show you an insurance company that will remain nameless. And I'm going to show you 2 contracts from the same insurance company, show you a couple things that we did different, just for an example, and you'll see, and maybe get sick to your stomach, about how a few tweaks and how it's radically different. And this is why I get fired up, because a lot of people that have bad conceptions of life insurance should. Because 95% or more should never have been replaced to begin with, especially permanent life insurance. And so, again, that's why you guys will have a lot of power at the end of this. And so what are some of the pros? Obviously, again, non-investment advice, okay? But some of the pros when setting these properly is there safety and liquidity. And I'm going to go through a checklist later, and so I just want to give you some of the pros, which we'll cover in a second, but some of the cons. And I want to be very upfront with this. If someone tells you that they're in anything, there's no cons to something, be really wary. So what are some of the cons? You don't get a tax deduction while putting your money. That's why it's really, really important to work with good tax strategists on the front end and try to do everything you can to permanently reduce your passives. You don't get a tax deduction going in most cases. There's some cases that you do. What I'm talking about, in most cases you don't. Second thing is, you don't get all your money in the first year. I'm being really conservative. Even if you structure these things properly, it might take 4 or 5 years before you have more money than what you put in these typical policies. So that's a con. And then not everyone qualifies health-wise. Now there's ways around this, but there are some people potentially in this room that may never be able to qualify for life insurance. Now there's, again, ways around it. If you have a kid or a business partner or something, you can figure that out, but at the end of the day, there's a con to that. Okay, so now we're gonna look at a typical policy. I'm gonna blow this up, okay, I promise. But this is the same company contract, a little bit different. I'll show you what we did differently. So we're going to start with the typical policy. And for those of you that want to take pictures, any of you, I will have at the end, you will get a copy of my book if you want. And if you want a copy of the slides, we'll give you our entire slide deck. Okay? So, yeah. So typical policy. Typical policy has what's called a high base. Little to zero cash value in the first couple of years. It's not flexible at all. It takes over 10 years to break even. And this is an example of what that policy could be. So for those of you that can see, how much cash value do you have in the first year? Let me see if I can. So you put, in this example, you put $50,000 in, and you have how much cash value? But you have $3.9 million death benefit. Year number 2, you put $50,000 in. You have how much cash value? 0. You have $3.92 million. Okay, third year, you put 50. You realize why people say that this sucks? Yeah, I don't know how people sell this, but people sell this stuff. I'm like, yeah, that's crazy. Okay, and so a couple things to write down. At the end of 30 years, you have we'll just say round up, 2.8 million of cash value, and you have $5.8 million of death benefit. Write that down. And in year 12, in this example, which is actually really good, this is a really good example. Year 12, you have more money than technically what you put in, lots of opportunity costs, and zero flexibility. Like you have to pay $50,000, and in year 4, I guess you have enough cash value that you could supplement that. But it's this is the type of policy when people say whole life insurance is horrible. Like I have empathy. I agree with that. Okay, so specially designed policy. What are the differences? We use what's called a PUA rider. We use what's called a term rider. It's just things that ultimately help with the efficiency of cash. We have a lot of earlier cash value, lots more flexibility. You'll see it has way better performance. We just get paid a lot less doing it. It's pretty much the difference. Okay, so here, and this again, this is not like, I'm not saying that this is the best design policy. I'm just giving an example of the same company. We just put a pre-UA rider and a term rider, nothing else, and this is the difference. So first year, instead of having 0 cash value, you have almost 40. Year number 2, you're up to $100,000. You have $82,000. In year 6, instead of 12, you have you have more money than what you put in this example. Okay. At year, how much did anyone remember what we had last year or last time? So end of 30 years in this example, you have $420,000 more of cash value in just this one example, and the death benefit is identical pretty much. You can't even make the argument that the other policy is better long-term for death benefit. The only argument that you can make for why you did the other policy is initial death benefit, and I'm a big fan of term insurance. There's a world where you can supplement initial death benefit. So the point that I'm making is you have a lot more flexibility. Really the biggest difference is the person designing this gets paid a lot less than the person designing the first one. Fascinating, isn't it? Okay, so when we're talking about an ideal foundational asset, we're talking about an ideal foundational asset, we have to come up with a couple different, like, what would this be? Okay, what would this look like? Would it be safe or not? Would it be easily accessible or not? Would it have competitive growth? Would it be leverageable? Would it have like built-in leverage to it? Would it have certain guarantees or not? Which is a really dirty word for in the finance space. But would you pay a percentage-based fees for this asset? Would it be free of regulation? Would you have contribution limits? Would you have certain creditor protections? Would you have deductible contributions? Would it grow tax deferred? Would you be able to use it tax-free? Like, these are all the things that you would be wondering. And so again, what I hate about what I'm about to share with you is I broke this down into red and green, and there's so many nuances to this. I'm literally going to break down how life insurance rate of return you should look at. I'm going to break down how you can look at it from a controlling aspect. But just hear me out here, because really when we're looking at life insurance, you should compare it to a savings account or something like that's liquid. Because I'm going to share with you in a second how you can use it like a liquid asset. So I'm using 401ks and IRAs just as an area of reference, but if I had to do this over again, I probably would just compare it to a like asset, which would be more like a safe liquid asset. So there's my disclaimer. But when it comes to safety, life insurance, is safe. A savings account is safe. When it comes to easily accessible, savings accounts are safe. Life insurance is safe. And again, like, it depends on a Roth and 401k are technically wrappers. A lot of people put their money into the market, and so you don't necessarily put your money into a Roth IRA for safety and easy liquidity. But when it comes to competitive growth, easily 401k, Roth IRA, knock that out of the park. That's why you do it. I'll make the argument later, and you can see how big the argument is that life insurance does have good rate of return, and you can be the judge of that for the asset, not the investment. If any of you want to invest in life insurance, you're in the wrong room. Okay, but from that standpoint, leverageable. I believe every one of these assets you can leverage against. Life insurance is one of the only assets that has built-in leverage. When it comes to guarantees, not all accounts have guarantees, percentage-based fees. When it comes to free of regulations, like, these are some of the things that, like, what are some of the values of things? I don't know. But we need to put a value on each one of these benefits. Contribution limits. Like, technically, there's people that can put millions of dollars into insurance products because there's no government regulator saying, like, you can or cannot do this. It's all based on what you're worth on paper. When it comes to creditor protections, every state's a little bit different. There's certain aspects that we don't get a tax deduction, but at the end of the day, when it's set up and used properly, it grows tax deferred, can be used tax-free, and there's this thing that we call the death benefit that also is a benefit. Now, if I'm being fair, I probably would use some of the yellow for some of these areas, and the red and green maybe don't give the best contrast. But when you start looking at this, again, when you don't look through the lens of it being an investment, it's a very attractive asset to have as a portion of your portfolio, especially when it's foundational. So we use the example of the smartphone as multidimensional. Some other people use a pocket knife, and your pocket knife can do multiple different things. And so Swiss Army knife, I'm losing my mind. What is that thing called? So like, that's another example of giving your dollars more than one job. Okay, so we're so good. So we all tracking? Okay. All right. So now what I'm going to do is I'm going to go through each section: lifetime growth, control, future cash flow, and protection and legacy. And by the end, you'll understand maybe how life insurance impacts each one of these. So lifetime growth. Okay. So section 7702 and 7702A. This is always, I knew this was tax play, so I had to bring up the code. And when set up and used properly, life insurance can grow tax-free, it can be used tax-free, and it can get passed on tax-free. So at the end of the day, Albert Einstein actually never said this, but he's so misquoted for saying this, I think we should just give him credit. So he said, compound interest is the eighth one in the world. He who understands it earns it, he who doesn't pays it. Okay, that's great, but what is compound interest? Just like, this is all things you know, but you need something to compound. 100% is zero, it's still zero. You need an interest rate. And not all interest rates are created equal. We just saw the fact a 10% versus a 15 is a massive difference. And then time. Okay, so in that same life insurance policy that I shared with you guys, you can see early on in the first four or 5 years, you're red, meaning the internal rate of return is negative. Meaning, if you cancel your policy in the first couple of years, you'll get a negative internal rate of return. After year 6 in this example, you now have a positive, what's called internal rate of return. And this is not just saying it's finally earning. This is saying we're taking into account all velocity years. So at the end, when this says a 4.58% in this example, we're not saying that it's finally earning 4.5%. We're saying that that's assuming that it's earning 4.58% every single year. This is an example done 2 years ago, by the way, when interest rates were relatively very low. The thing about life insurance is they don't move quickly, and so this is an example like a year and a half ago, you're comparing to savings accounts that don't even reach 1%. I understand that right now savings accounts are at this level or more, but there's a good argument to be made if interest rates stay high that these numbers will ultimately increase as well, if that makes sense. So when you look at this, okay, 4.58%, no one's getting excited about that number. Everyone in this room can earn a greater return than that. That's why this is not an investment. But we really have to ask the question, compared to what? What are we comparing this to? Are we comparing this to, what Tony Robbins talks about in his book? Are we comparing this to real estate? Are we? Yeah, tier 1 asset, baby. I love that. Okay, so it's interesting. So if we take up 4.5%, we just earn. If we're comparing this to maybe a savings account, and let's say you have a 30% tax rate. Maybe not in this room because you guys all know how to bring this down. But there's some people. We're in the great state of California. 30%. Now you need to earn over 6.4% every single year in your savings account just to keep up with the board on the life insurance. You see what I did there? Because you need to pay taxes on the difference. And so what if you add a 1% management fee? What if you include the cost of term insurance? I'm not saying that whole life insurance is going to get you more than 10%. That's not what I'm saying. I'm saying if we compare it to other life assets, if we compare it to an asset, I'm going to show you in a second how you can utilize that asset. If you compare it, and then you say, what do I have to earn in another asset that gives me control that I can liquidity, but that 4.5% is tax-free if set up and used properly. In other accounts, you have to pay taxes on that, and that's built in with all the fees. What if I have to pay extra fees? And if I don't do that, I need to use term insurance to insure my family. So I'm just saying that there's a good argument to be made that, again, I'm not saying that you should invest. I'm just saying for the reason I make this green as an amazing rate of return is when set up and used properly, if you understand where this goes in your portfolio, I believe whole life insurance gives an amazing rate of return if you understand the like asset. Okay, we're going to move on due to time. The key thing here is continue to compound to the day that you die. Continue to compound to the day you die. Okay, so number 2 is control and use. When life insurance is set up and used properly, you can access your money through a collateralized loan, allowing your money to grow. How many of us use credit cards versus debit cards? Okay, we understand that if we have a balance on our credit card, it can be a bad thing. I'm not saying that everyone should use credit cards. In fact, I actually think Dave Ramsey's right. In the majority of the population, credit cards are a bad thing. Everyone in this room probably uses credit cards, and you get points. We're gonna hear from some incredible people later today that literally hack using the power of credit cards. But you're potentially making the same purchase, but some have a lot more points and protection versus others. I would think about this as using a credit card versus a debit card. And so we have real life examples of people that invest in real estate using their life insurance. They, are starting businesses and having emergency funds using their life insurance. They're investing in individual stocks and invest in index funds and Bitcoin miners and buying gold and silver and education. You'll get the point. I'm not giving any investment advice, but just imagine if you name it, someone's probably used their life insurance policy for that activity. We've even had a client that flipped, how some people flip houses? They flipped cows. They made 3,000% on their cow flipping, and they used their life insurance in the process of doing that. We have people that do land investing. My good friend Justin Donald, who is a lifestyle investor, he literally writes about this in his book. He uses life insurance to acquire companies. And so how does this work? You have your money's growing the rest of your life. You have built-in ability to borrow against it. And at the end of the day, you can buy an asset or liability. Obviously, the more assets we buy, the better the liabilities. But that's how it works. And so the way that this is a picture that you guys might want to take a picture of. It's like this is you. This is Karlton. He's saving his money. He is his greatest asset. He's building up an emergency fund for his business, his family. Everything above that is an opportunity fund, and that's when you actually invest. That's when you double down and invest in yourself, your real estate properties, businesses, whatever you want to do to help you get closer to where you want to go. And so another example of this is essentially, creating this flow. Insurance is not an investment, it literally is the foundational place. Are we understanding this? Okay, cool. All right, so moving along, when does it make sense to borrow? This is the question I get. When should I borrow against? here's the answer. When your activity is greater than the cost of borrowing. So we call borrowing cost control cost. And so if your activity, you value that more than what it costs you to borrow, that's a good thing. If not, don't do it. Borrowing doesn't make you rich on, like, leverage is an amazing thing when done properly. If not done, it's not great. So here's an example of banks. This was done a couple of years ago, but back in the day when we were making 1%, let's say Karlton came into the bank and he gave me $100 on the bank and I gave him 1%. Karlton, my investment is that $1 because I'm the bank. And now I loan it out to you for 4%, okay? What kind of rate of return did I at the bank make? 300%, because my investment is that $1 and I made $4 with $1. That's why they hand us suckers every time. They want to kind of remind you you are a sucker every time. You'll never go to the bank again and think every time you see those lollipops.
Hey, it's Caleb Williams here. I'm just interrupting this video quickly to invite you to check out our And Asset Vault. You may have been there. We've actually revamping it. And if you are somebody that wants to learn more about, is life insurance the right fit for me? Does this and asset make sense? Does this actually help me be more efficient? We've put together a 10-minute documentary style video that I think does a really, really good job giving the history, why the and asset, different setups and designs that we use. And then we have an and asset vault that gives case studies, calculators, handbooks, and so much more. We are here to serve you, whether it's a conversation, whether it's education, or the video. So make sure to go check out andasset.com/vault to learn more.
For me, it's this concept of controlled compounding. You're telling me that I can control money. I can control money while it compounds. Again, not an investment, but over my lifetime, if I can get, that consistent internal rate of return, and I can start thinking, where can I actually utilize my money as an opportunity fund? How can I generate more wealth? Or who can I go to that can really help me move the needle? Now you're getting $1 doing two things rather than just one. Are we getting that? Okay. So now I'm going to talk about a word that I think should be a swear word, the word retirement, but I use it because everyone talks about retirement. Retirement should just be called future cash flow planning, but there is so much research going on right now on how life insurance, believe it or not, can enhance and give you more options for retirement income. It's very interesting. This is something when I first got into this space, not a ton of people were talking about, and over the last couple of years, a lot of people have been talking about this. And so, retirement 101, you get up the mountain, but now we have to get down the mountain safely. Okay, so how do we do this thing? And so I already said this, when we call retirement planning, it should be called future cash flow planning. So there's a lot of experts out here. Ernst & Young, they just did a study a couple of years ago, and they literally said insurance with investments gives you potentially more options than just one or the other. So they're not saying insurance or annuities are better than investments, but they are saying if all your money is in investments, period, you could have a problem when it comes to taking that money out and income. And so there may be a world where you can use products diversification to increase that. And someday if I'm really bored, I'm going to write a book that nobody will buy, but it literally will be learn how whole life insurance can increase your future cash flow and reduce your risk and give you more options to establish a better legacy for your family. A little bit wordy, but you get the point. But it's just interesting to me. It's if everyone in this room are entrepreneurs, but there's some people that should just buy life insurance just as a portion for the bonds or just as a portion of their portfolio and give them more options in the future. Very interesting. And the cool thing is, if this is true, by having it in your asset today, it's just going to give you more options in the future. And so, again, I don't have time to get into all of this, but it's knowing the fact that we're all going to die. If we have a unilateral contract with an insurance company that has to keep their end of the bargain, we know that we're going to die someday. We think that's an actual valuable asset that we could leverage while we're alive. If I have a $2 million death benefit and I'm 85 years old and I'm not doing so hot, I'm going to get that. Do you think that could potentially be valuable and I could get creative with that?
Yeah.
Okay. If you have an asset that's not correlated to the market and the market's going doing all these things and you can potentially let the market or your assets rebound and take from something that's not correlated, there's benefits to that. We all have some type of potential pensions in our future depending on where Social Security is going to be and what annuities are going to be. And at the end of the day, there's different pension payouts. And if you have a permanent death benefit, it potentially gives you the ability to take more income, be more aggressive taking income while you're alive, knowing that the day that you die, your spouse can get the death benefit instead of taking a lower payout early on because you don't want to leave your spouse high or dry. So this is an example. There's some people, reverse mortgages is a whole other 60-minute talk that's like less popular than life insurance. Just the point is there's some people that want to get creative with some of their debt, and they feel more comfortable if they have a death benefit that ultimately allows them to potentially take out money, different aspects while they're alive, knowing that they can give their kids the option, do you want the house or do you want money? And then there's a strategy that I'm not going to get into called featured asset tax shelter, which is used when people buy and sell big activities. They can use your life insurance policy to recycle that money. Okay, last portion I'm going to talk about. So do we understand that it's possible to have your money grow the rest of your life and use it, and it can give you options in the future? I'm not telling you what those options are going to be, but my opinion is more options are better than less options. Okay? So protection and legacy, this is an and, remember, this is not an or. Protection and legacy, when life insurance is set up and used properly, it can provide protection. I love California, but I'm on the Florida bandwagon, Karlton, especially when it comes to creditor protection. California is not a great state for creditor protections. I don't want to share that on this slide, but it's like there's certain states, California, Texas, very good creditor protection, and this is an example of like your life insurance is 100% creditor protected. Some states like California, not all your money is creditor protected. There's examples, and this might like make you feel like bad, but like there's examples of like Enron executives that literally committed fraud, but are still getting some of their money from life insurance and annuities because in the state of Texas, there's amazing creditor protections with these assets. That's messed up, but it's also really, really cool if you think about it. I like this group. You guys are good. Chronic illness, right? So essentially, there's other benefits in life insurance that, God forbid, and some of this will happen while we're alive. Like if there's things that happen, we're not dead, but it's really tough, especially medically. There's ways to spend down the death benefit while you're alive. It just gives options. I know somebody that's alive to this day because they used their chronic illness rider to do alternative medicine, and it kept them alive to something that they had 6 months to live. And 3.5 years later, they're alive. I'm not going to say it's all because of life insurance, but like the chronic illness rider gave them the ability to make moves, and they're still breathing to this day. Very interesting. And then obviously when it comes to estate planning, a lot of estate planners utilize life insurance as it relates to properly fund an estate. So as I wrap up, I wanted to share with you this gentleman right here. His name's Greg Heelman. He's like a second father to me. He was actually the gentleman that flipped cows. Okay? And Greg believed in me. I could talk a lot about how amazing Greg was. And March 26, 2019, Greg went to be with the Lord. He battled lung cancer, and I got to see one of my best friends and the father figure pass away. And it was very, very interesting because it continued to remind us like why we do what we do. And he would keep saying like, Caleb, intentional living, cherish every moment. And that's ultimately why I started all our talks with wealth efficiency, because at the end of the day, you're not wealthy if you're not living intentionally. And I would encourage every single one of us to really lean in. If there's days that go by that we're not living intentionally, like shame on us. Like life is way too short for us to continue to make that a reality. And so what's interesting is we actually did a podcast. If any of you want to listen to it, I'll give you the ability to reach out to us, and I would gladly share this. He talks about his family and upbringing, but he also talks about like he was my first death claim, which is messed up. He was one of my first clients. At the end of the day, his family was better off financially because he made certain decisions like this. It's just a good example of like, yeah, I talked all about controlling your money and growing your money and options and protection, but at the end of the day, we're all going to die someday. And like, it is pretty cool to think like we can make decisions today and make sure regardless if we live 30, 40, 50 years from now, we can make sure that our future is fully leveraged and funded like we're going to live and make that happen. And so, yeah, that's all I'll say. And because time is running down, I hope we understand that when we look at our cell phone, we don't look at this as an investment, but we look at this as a foundational asset. And so my encouragement is, I use life insurance as an example, but let's look at every aspect of our life and say, how can we be more efficient? How can we be more effective? How can we lean into intentionality? How can we remove friction to getting to where we want to go? Are you impressed? We have 30 seconds left. They were like, there's no way you're going to do this whole slide deck, so thank you guys.